channel. I'm Doris and I'm here to share with you the updates for my stock account. Today my stock account has made a loss of $2,043. US stocks closed higher on Tuesday. Powell said inflation was cooling. In my account right now, the net asset of my account is $66,663.26. Today, including the post-market price, I've made a total loss of 3.63% of the $2,512. So the SQQQ made a loss of 6.18% to $33.38, and DRV made a gain of 1.21% to $40.14. The market today showed an overall gain, with the internet content and other tech sectors showing a gain of more than 3%. The internet content and information showed a gain of 4.20%. The oil and gas also showed a gain of more than 3.5%. On the many other industries, though not showing as much gain as the tech stocks, tech sectors, it also showed a gain of a positive gain. Dow Jones Industrial Average rose for 0.78% to $34,156.69. Nasdaq Composite Index rose for 1.9% to $12,113.79. S&P 500 rose for 1.29% to $41,064. Investors continue to review earnings and weighted Biden's second State of the Union address. Mr. Powell said the strong non-farm payrolls report shows the Fed needs to continue raising interest rates, but that inflation is cooling and will fall sharply. Fed Chairman Colin Powell said on Tuesday that employment data remains strong and it is necessary to cool inflation with further rate hikes, and that interest rates may need to peak higher than previously expected. We think we need to raise rates further, Powell said at the Carlyle Group co-founder David Rubenstein at the Washington Economic Club on Tuesday. The labor market is unusually strong. He added that if employment situation remains hot, we're likely to have to do more. Asked if a 50 basis point rise was expected last week, rather than actual 25, Mr. Powell said no, we're not going to do that, he told Rubenstein. Investors expect the final interest rates to raise above 5%, now after the unexpectedly strong non-farm payrolls data for January, similar to what the Fed forecast in December. Mr. Powell said had previously argued that easing pressures in the labor market could help cool prices. Again, price gains in core services except housing. At a press conference after last week's meeting, Mr. Powell said the Fed was committed to a tightening policy, further until inflation falls significantly, which requires a broader cooling in demand across the economy. But on Tuesday, the labor market data showed U.S. non-farm payrolls surged by 517,000 in January, much more than expected, and the unemployment rate fell to 3.4%, the lowest since 1969. Powell said the report tells you why we think it's going to be a long process. While some inflation indicators have cooled in recent months, Mr. Powell told reporters last week that officials needed to see a lot more evidence to be sure that inflation is on a downward path. Powell's speech came after Minneapolis Fed President Neil Kashkari said on Tuesday that the Fed had not cooled inflation down enough to declare a victory. He was surprised by the January non-farm payrolls report because it did not show what impact the Fed's monetary tightening action had on the labor market. He said the labor market must be balanced, and the central bank has not done enough. He said, we still have work to do. We know that the raising interest rates can curb inflation. We need to proactively raise interest rates to set inflation caps, and then let monetary policy work in the economy. In an interview on Monday, Treasury Secretary Janet Yellen said, "When you have 500,000 jobs and the unemployment rate is at its lowest level in more than 50 years, that means the chance of a recession is very small." Atlanta Fed President David Bostic said on Monday that a strong U.S. jobs report for January added to the possibility that the Fed needs to raise interest rates at a peak higher than market expectations. Bostic said, "If the stronger than expected economy continues, that could mean that we have to do more. We expect that could prompt us to raise rates more than previous forecasts." Bostic reiterated that interest rates would reach 5.1%, in line with the median value of policymakers. December forecast, and will remain at the levels throughout 2023. The market may be the most worried place that heavy economic indicators too hot will let the Fed to upgrade the monetary policy. The market is expected 1 to 2 times the tightening cycle will end, such as the improved number of raising interest rates or overturn year cut expected. This is for the current too optimistic market. Big probability will cause catastrophic blow. Market expect 2 or more rate hikes for the rest of the year, since the Fed raised a 25 basis point rate in January. But now markets are growing concerned that the Fed will do more after strong labor market report. Its Fed Watch tool showed a nearly 100% chance of another 25 basis point hike at its March meeting, with even interest rates further future traders saying the Fed could raise a 50 basis point rate, with expectations of hike in May and June rising rapidly. The market's projections of peak interest rates have soared from 4.9% to 5.1% in just 2 days, almost exactly in line with the Fed's median dot plot rate released at the end of the last year. Markets expect the Fed to announce only 1 rate cut a year ago, rather than 2 rate cuts previously expected. In addition to Powell's speech, President Joe Biden will deliver his second State of the Union speech on Tuesday, and analysts widely expect the economy to be a major theme. Some analysts predict that Biden's speech will call for additional reforms to reduce the deficit, to ensure that the big and rich companies pay their fair share. David Mike Wilson, chief strategist at Morgan Stanley, said the market didn't care about the fundamentals last week and continues to absorb the bear market, especially tech stocks that overfell in 2022. Stocks surged despite poor results. Wilson said this was unsustainable. While we have the same respect for market prices as much as everyone else, it is worth noting that in the previous quarter, the stock market rose on bad news, but when the bad news followed, the market fell again. Wilson further noted that, historically, the decline in stock prices have mostly occurred after expected negative earnings per share growth. In addition, our future earnings forecast path means a further significant deceleration in earnings growth. Wilson said that the current earnings recession is not reflected in share prices. Forward growth at the S&P 500 EPS just fell to negative last week. This just happened 4 times in the past 23 years: 2001, 2008, 2015, and 2020. Each shift from positive to negative earnings led to a stock market decline. He also reiterated that he would not fight the Fed, betting only the rally at the moment. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.